Okay, hello everyone. Now we are going to learn how to journalize and post closing entries. The first thing that I'd like to do is review what we've done and what we've already learned. We've really talked a lot about the accounting cycle. And the accounting cycle had, when we talked about it, a few major components. You started with a transaction, you went to the journal, you posted it to the ledger, you put it in the statements, then it went back to transactions. Now, just like the way we did with the accounting equation, we expanded it. Now we're going to talk about the expanded accounting cycle. Of course, it will start with where we analyze the business transactions. Then we will put them in the journal, make our journal entries. And then what do you think is the next step after the journal entries? Of course, then you have to post it to the individual ledger accounts. And then once we did that, the last step that we did with the demonstration problem is, then what did we prepare? We prepared a trial balance. We wanted to see if everything equaled, if what came in and what came out equaled. Then what was our next step after our trial balance? Yes, you're right. We had to make adjusting entries. And what accounts did we make the adjusting entries to? Do you remember? It was two accounts. Yes, supplied and a prepaid expense or prepaid insurance. Then, once we did our adjusting entries, then the next step on the worksheet was to prepare the financial statements. And we did that. We put our other revenue expenses in the income statement columns, and then the balance sheet columns were the assets, the liabilities, and the owner's equity. Now what we're going to do now is learn how to close the accounts and why that is necessary during an accounting period. So, what are closing entries? Closing entries are also called closing journal entries. They are made at the end of the accounting period. They are used to zero out all temporary accounts. And that is a new word for us, a new term for us. So it'll zero out all temporary accounts, and it will transfer the balances to a permanent account. Okay, so do you remember when we completed our demonstration problem? We brought our ledger accounts up to date by doing adjustments. Again, two accounts that we adjusted were our supplies and our prepaid expenses. Now we're going to use the income and balance sheet columns of the worksheet to prepare our closing entries. But we need to learn about the use of two accounts that are used in the closing process, and they're called permanent and temporary accounts. The need for permanence, similar to I think of it this way. Something permanent is like a tattoo. Ever thought of getting a tattoo? Once it's there, it's permanently there. Or of the kind that will just stick to the temporary sticker tattoos. Their same concept can be used when you explain permanent and temporary accounts. Temporary are really called nominal accounts. These account balances are not carried over from accounting period to the next. You don't necessarily close the accounts, but the balances are zeroed out at the end of each accounting period. So temporary accounts are the revenue accounts, expenses accounts, the owner withdrawal accounts, and that income summary account that everyone kept asking about. The purpose of the temporary accounts is to show how any revenues, expenses, and owner withdrawals has affected the owner's equity account. Temporary accounts show changes in the owner's equity capital account for a single fiscal period. At the end of the period, the balances of these temporary accounts are balanced, transferred to the owner's capital account. Temporary accounts always begin a new accounting period with a zero balance. That's what's important about a temporary account. When you start a new accounting period, the balance is zero. Permanent accounts, also called real accounts, are companies' accounts whose balances are not carried over. They're not closed from one accounting period to the other. So if there's a balance, the balance carries forward. Permanent accounts, as you can see from the diagram, are assets. We own those. Liabilities. And of course, the all-important owner's capital account. Again, closing processes apply to temporary accounts. Those are the accounts that get zeroed out. Permanent accounts do not. Permanent accounts are found on the balance sheet. These permanent accounts actually show the worth of the company at a specific time. To summarize the need for permanent and temporary accounts, accounts used to accumulate information or balances from one fiscal period to the next are your permanent accounts. Permanent accounts are also referred to as real accounts. Accounts used to accumulate information until it's transferred to the owner's capital account. Again, it's called a temporary account. And temporary accounts are called nominal accounts. Now there's a need to close these temporary accounts. That is, because those account balances cannot be carried over from one period to the next. And the way that we close them is we use journal entries. Hence, they're called closing entries. Again, remember, logic, just follow the logic in account. Temporary account balances must be reduced to zero at the end of each fiscal period. And that's what we're going to be working on. The reason is, remember the concept of matching expenses with revenue? Please look it up. If you do not remember, this is a very important concept. Income summary. We've seen it in the stuff that we've done for Delgado. We've seen it there. We've looked at it. We haven't done anything with it. Well, now it's time to understand the need for the income summary. The income summary. So whenever a temporary account is closed, the closing entry must have, of course, it must equal, debits must equal credits. Always. If an account is debited for $3,000 to close the account, some other account must be credited for the same amount. So you create an account titled Income Summary, and this income summary is used to summarize the closing entries for the revenue and expense accounts. The income summary is unique because it does not have a normal balance side. The balance of this account is determined by the amounts posted to the account at the end of the fiscal period. Is an account, and it's a temporary account, and it's only used when you close out the books. And it stores income statement account values. Think about what it's telling you. An income summary. What does the income statement tell you? It tells you what you made. What two types of account are on an income statement? And I want you to answer this question and write it down. What two are they? I hope you got this right, and I'm sure you did because you guys are so smart. Yes, revenue and expenses. Those are the two types of accounts that are on an income statement. So, just as I stated on the slide before, the need for the income summary account doesn't have a normal balance side. So when revenue is greater than total expenses, resulting in a net income, the income summary would have what kind of a balance? It would have a credit balance because income is a credit balance. And I'm going to show this using a T account. So there's total expenses. Expenses are always a debit. Credit. Of course, if it's net income, you're going to have to credit it to zero it out. Credit balance is when total expenses are greater than revenue, resulting in a net loss, the income summary would then be a debit balance, as shown in the T. And I'm trying to get this to where you can see it a little bit better. Oh, I have to do it again. Total expenses are greater than revenue. Debit is the loss. And then in class, we're going to go over the closing entries for Delgado so that this can all sink in. And please come in with any questions, and I'll be happy to answer them. See you tomorrow.